Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Well, happy day, 7 investors. Good afternoon, and welcome to 7 Investing Now. My name, of course, is Daniel Brooks Klein. I'm the host of the program. I'm being joined today by Simon Erickson, but this is not a regular show. We're not doing the regular lead story, what we're watching, home stretch. We've got something very special up top. After we get through the something special, we're going to talk about why the market right now isn't the same as the 90s .com bubble. Then we're going to talk best investment advice we've ever gotten. But first, Simon, it is time. We have a giant announcement. So let me turn the show right over to you.
Oh, thanks very much, Dan. Such exciting news to announce here this morning. And first, to frame this, we set the bar really, really high here at 7 Investing, right? We want to go out and we want to find the most innovative companies that are available in the stock market. And to do that requires a really technical person that's really cutting edge and in front of what else is going on out there in the market. And then on top of that, we're holding ourselves accountable, right? We're putting our feet to the fire. We're transparently reporting our returns in real time at 7investing.com/recommendations. All the time, you can see how our picks are doing. We're not just hiding behind the winners. We're showing every pick out there for everybody to look at. And in addition to being innovative and being credible, we also want to be very helpful, Dan. We want to go out there and have live stream conversations like this that are really interactive so that we can help and empower people to be better investors. And so with all of those kind of in mind, right? You know, we really wanted to find the right person. And the person that I'm about to introduce just checks every one of those boxes so perfectly, being innovative, being technical, being ahead of the curve, and being very helpful. And so it's with great pleasure. Go ahead, Dan. Go ahead. You have one more.
I just want to say, before I let you take this and disappear into the background for a few minutes here, when you made this announcement to the team, it was jaw-dropping. I literally think there was like silence for 90 seconds because we were so impressed. Now, one of the games we all play is trying to figure out who the person is going to be. This is not someone that was on any of our radars because we thought it was an impossible get. This is someone many of us were aware of going into this. With that, Simon, time for the reveal.
This is a huge win for 7 Investing and for our subscribers. And so it gives me great joy to announce that we are expanding our team today. And as a new lead advisor for 7 Investing, I would like to welcome Anirban Mahanti. Anirban, welcome to 7 Investing.
Thank you very much, and you guys are too kind, in the way you describe me. But I appreciate those kind words, and excited, delighted to be here to help 7 Investing, the team, and of course our subscribers. And I'll just point out one thing very quickly. Sure. I was a subscriber until I got my free sub.
Day one, I think, or first week in Anirban, you were an early subscriber of 7 Investing.
I've been a fan of Simon, the work you do. We go a long way, and I like what you guys were doing, and I was a subscriber. I was a paying subscriber. So,
well, an added perk of being an advisor is you actually get a free subscription now. We'll include that as part of everything. But Anirban, the first thing I'm going to point out is that it's bright and sunny out here in Texas, but where you're calling in from, it's actually the very early morning and it's dark outside still. Tell us a little bit about what it's like living in Sydney, Australia.
Oh, yes, you're right. So, the background on my lighting, it's a little dark, and I've got a light that helps with shining the bright light here, but it's 3 a.m. in the morning right now in Sydney, Australia. Australia is a beautiful country. For those people who haven't visited, I would, once the borders open, I would suggest people put Australia on the bucket list of places to visit. We are more than kangaroos and koalas, beautiful beaches, lots of great food. In many ways, it's not much different from being, say, the US. It's a modern democracy, maybe similar history going back in time, 200 plus years, and great place to live, great weather almost all year round, except for when it gets really hot. And with some of climate playing havoc, it's been, we've got some flood and stuff like that. But other than that, it's a fantastic place to live.
Well, good day, first and foremost, and really looking forward to bringing your international perspective to this team. Anirban, I'd like to actually point out that you've got a really extensive resume, a technical background, something that includes getting a PhD in computer science from the University of Saskatchewan. You actually spent some time as an assistant professor at the India Institute of Technology out at Delhi. You also were a research director at NICTA down in Australia, which is one of Australia's largest research institutions, and also the research director and a portfolio manager at the Motley Fool down in Australia as well. And so my first question as we're introducing you to our 7 Investing audience is, with such a technical background, and on top of that, I know that you've also got more than 70 research papers that you've co-authored and have actually been peer-reviewed by people all over the world. Such an incredible background you have, Anirban. How has this influenced you as an investor?
Oh, that's a great question. So, when I was doing my PhD, I might be giving away my age here, but when I was doing my PhD in the 2000s in Saskatchewan, we were working on video streaming sort of protocols, right? This is, if you think about the time then, right? This was before everybody was watching YouTube. YouTube did not exist at that point, and Netflix was probably still in the DVD mail-in phase, right? So we were working on these protocols that allowed for what we call scalable streaming, which is essentially how do you stream to a large number of people at the same time with minimal latencies, which is lag, and seamless on the internet, which at that time would not be that easy because the internet was not the internet that we have today. And so what I've seen is, one of the things that I've seen is technology at universities, leading edge, that get published and peer-reviewed in top conferences and journals and so on and so forth. They tend to be at least about 5 years ahead of what you see that comes out of the industry, right? And I've seen that many times, and I saw that happen. I've seen protocols that people have developed, which then Apple, for example, have incorporated in their technologies. I've seen, I was using machine learning, and when I was an assistant professor at Calgary, for a lot of work, including looking at network traffic that's going through our gateway and trying to figure out what the traffic is without actually looking at the data, right? So looking at traffic signatures, which is what a lot of cybersecurity companies today are, for example, doing malware detection. People are doing, right? What you could see is that these technologies are getting applied, and that sort of made me think, well, I could actually take some of those skills that I have learned over time and things that I have appreciated and actually apply that to my own investing in a serious form. And that's what made me actually, make the jump. So, I became more and more focused on tech investing much later, around say 2010. So after about 10 years of doing research, I became focused on trying to, utilize that to my own advantage. And then later on, after doing that for some number of years, I thought, well, it's a great idea to try to take that and become a professional investor, because you can again spend more time doing investing. All right, and the journey from startups, from research labs or industry research labs to startups, to how companies get acquired by big companies acquire startups. It's an ecosystem, right? And if you look at the ecosystem, it can be a serious edge in terms of investing. What I call investing in bleeding edge companies that are ahead of even the innovation curve, right? So not leading but bleeding edge companies. So that's what I sort of try to do and utilize sort of my background to look at it.
I think it's so important, Anirban. We always talk about the S curves, and if you get in early, there's an early majority that finds those companies, even when they're still academic, maybe they're still in kind of research phase. But if you see those quantum leaps that industries are changing, that's what's disrupting everything out there. And I think that you have really got such a great viewpoint of that, such a technical perspective, such a research perspective on how things are changing. In fact, you and I, we go back several years. We worked together for several years. And I still remember a long time ago having a dinner with you at a conference, and we chatted about how different Tesla was approaching self-driving and autonomous driving. And that was very true. And I mean, that's something that wasn't really being talked about, at least in the headlines of the news at the time. I'm really looking forward to bringing those perspectives of yours to 7 Investing. And so let me ask that as my next question then. With such a technical background, it's influenced you as an investor. How would you self-describe yourself as an investor? You said you're looking for bleeding edge companies right at the forefront of innovation. Risk on? Are we ready to take some risk out there and find some small cap companies, or what kind of companies are you looking for?
Oh, that's a great question, Simon. I mean, before I even talk about that, one of the things that you actually have been doing, right, for a long time is going to these trade trade shows, right? And that's again a great place for ideas, right? You find things that are happening on the ground, and then you can discover things. So I mean, there's so many ways in which we can find cool ideas. My approach is I'm very agnostic in terms of market cap. I really actually don't care about market cap, because typically they tend to be mid cap to early stage large cap, for example. Because companies have established themselves, they've got some revenue, but most of the market participants, the broker reports are not out there, and they're at least not talking about the things that are relevant, right? And Tesla is a great example, right? It might be a mega cap right now, but people still don't get what's happening with self-driving, for example, right? There's a lot of controversy, a lot of misunderstanding of what's going on, right? And there's just, for example, this general belief that everybody can have self-driving, right? And the thing is that everybody may have self-driving, but how is that self-driving going to happen? It's exactly like saying every phone is going to be a smartphone, but they're actually basically two vendors for the smartphone operating systems today, right? Not even a third vendor, it's basically two vendors, right? So the Apple, which provides its own phones, or Androids, right? So it could be like, I think, everybody is going to have self-driving, but which are the companies that are going to bring those technologies to the forefront is what matters. So in terms of what I do is I try to find companies before they sort of hit the mainstream, as I said. So these are bleeding edge. I call them bleeding edge because these will be using technology in novel ways to solve important problems. And one of the key things I look for is it a legacy industry that can be disrupted? Those are actually my favorite ones, because if you think about a legacy industry, one of the things that happens, and you just talk about this S-curve adoption thing, but one of the things that would happen in the legacy industry is the legacy player would have a hard time actually switching over to the new thing, because it's going to disrupt their existing business model, right? Right up all the way from how they're set up to how they actually do business to what they sell. That is incredibly hard to do. That's what gives opportunities to startups and new ideas, right? So that's one, that's a very, very, ripe area to harvest in. So I love harvesting there. And lots of things, a lot of the software companies actually fall in that category as well. The other one really is to find completely new areas that, are starting to evolve, right? So a great example might be, if you think about something like teledoc, as an example, right? I mean, telehealth isn't new, right? I mean, telehealth, if you think about, in academic literature, has been talked about for ages. But sometimes you just need a bunch of things to fall together in the right place for the technology to take off. So those really create completely new opportunities, right? I mean, it's not that net telehealth is going to take away opportunities from existing. It may, but I mean, it is creating an all new way of expanding and providing healthcare. And those tend to be, again, just think about it. That's basically like looking at a company and saying, well, e-commerce is going to become a big deal, right? I mean, e-commerce really is changing the way, people buy and sell things, right? So I think those are sort of the two things I try to focus on. That doesn't mean that I wouldn't pick a company that I think is a nice value and stuff like that. But my bread and butter is really here. That's what I focus on, those two sort of ideas.
Yeah, fantastic. Now make sure everyone grabs a nice cup of coffee and is highly caffeinated. When Anirban's talking about kind of these companies in the early adoption curve, we mentioned e-commerce, we mentioned Tesla, we mentioned Teladoc. All of these are embracing innovation. One last question before I want to open it back up to all of us to talk about technology companies as a whole is, Anirban, even though you're based down in Sydney, living in Australia, I know that things are a little bit different in the terms of the stock market down there than the United States, but what types of companies are you looking for? Are you looking for Australian companies? Are you looking for American-based companies, international companies, a little bit of everything? What should we expect from you?
Yeah, so at a previous job, of course, I was looking at Australian companies because I was primarily focused on the ASX. As an investor, though, for as long as I can remember, my portfolio has essentially been 90% international, right? And there's a reason behind it, and I think it's very, very important actually for investors to realize. One is that most of the best companies in the world would list in few different, there are like 3 or 4 exchanges they're going to list on, right? So the best Australian company in software, for example, Atlassian, is listed overseas. And that's because that's how the capital markets work, right? Companies will go where the money is, because eventually that's what you're looking for, right? So there's a market, So most of the time I'm looking for, I've personally invested in companies that are listed either in NYSE, New York Stock Exchange, or the Nasdaq. In terms of companies' headquarters, I really actually don't care where they're headquartered, largely because most companies these days, if they are of any substantive value, are international in form, right? I mean, let's use Apple as an example. The majority of revenues come from outside the United States, although it's headquartered in the United States. So it's almost just like we live in a global world, every company is actually global. So at least every company that is worth investing in should be global. Otherwise, they're basically leaving large masses of opportunity, just giving up on it, right? So I think, I'm looking for global companies. Sometimes I'll find interesting things from emerging economies, because I'm especially interested in sort of emerging economies. But again, I tend to mostly focus on tech, at least with the tech bent. So that's how I at least invest. So and that's what I'm looking to bring forward here at 7 Investing.
Well, we're really looking forward to it as well, Anirban. And your first recommendation will actually be available for subscribers on April 1st. I think, this is kind of the only chance I get to welcome you as the very first day to the team. But oh my gosh, I can't tell you how excited we are to have you join 7 Investing. Just your technical background you have, coupled with your love of sharing the love of investing with people, and just the mission that we have of empowering others. Really a great person to chat with over the years. And I couldn't be more excited to have you on the team. So welcome.
Thank you, Simon.
And of course, Anirban, if you turn around, you'll find that Simon has flown the entire 7 Investing team. No, he is not.
We'll be in the city when we can, for sure.
we look forward to when we can all be together. But so let's recap a little bit. This makes 7 Investing international. It doesn't mean we weren't investing in great companies and picking great companies all around the world. But one of the things I like most about this team, Simon, and we can go through the 6 of us a little bit as our promo here, is that we all bring something different to the table. You talked, Anirban, about sort of researching these early stage tech companies, bleeding edge as you called it. And to do that, you have to understand the market. To look at what YouTube was going to be back when the internet was dial-up and it took like 10 minutes to download a photo, you have to be on the edge of that. Well, I'm on the edge of that when it comes to retail and cord cutting and some other spaces. Max Chatsko is on the edge of it when it comes to biotech. Simon Erickson, why don't you go through the rest of the team as we talk about all the great things you get as a member of 7 Investing?
I think so. It's a great point, Dan, that we're not all looking at the same types of companies. We want to lay out, as we always say, at the buffet of options, whether that's retail companies like you just mentioned, biotech companies, artificial intelligence companies like Anirban was talking about earlier. Steve Simonton's looking at a lot of software companies as well. My pick that's next month is a cloud computing company. We've kind of got everything. And then Matt Cochran, of course, looking at a lot of finance companies, banking companies, things like this. We kind of offer a whole bunch of options every single month. And the first of the month is when we publish our recommendations. And we talk about those throughout the month through our subscriber calls, through our team calls, where you actually see behind the curtain of us kind of, hammering it out and looking at all of the good and the bad things with each one of these recommendations, trying to be as thorough as we possibly can for those reports, and then continue to follow along everyone's investing journey over the long term too. So it's not just a recommendation reports that publishes on the first. This is a long-term journey, because we think that the power of investing is compounding wealth over long periods of time.
And of course, if you'd like to be a member, for $17 a month or $170 a year, you could sign up at 7investing.com/subscribe. This is a really great time to do it, because you're about to get our new picks. Now, you also get access to all our past picks, all of our past members only content, all sorts of great stuff. And now, of course, you get our 6th lead advisor. Simon, I will point out, we have 6 lead advisors. We are 7 Investing. Let's just say big things are coming ahead. As we say that, let's get to the top story today. It's why today's market is not the 90s.com bubble. We hear this a lot. People see highly valued tech companies and they go, oh, 90s.com bubble. Anirban, I'll let you do the honors of go first, but I lived through the 90s tech bubble. I actually was editorial director at uproar.com, a top 25 company, top 25 website in 1998. So you aged yourself a little bit there. I'm still the oldest person on the team. I was through the 90s .com bubble and got to see a company with incredible amounts of page views. We had a 1 billion page view goal one month at a time where most people weren't online, and we hit it. You know what we didn't have? Revenue. There was no revenue, and there was enormous technology cost. Anirban, why is this not like the 90s tech bubble?
Well, this is a we can go on this one for several hours, right?
And we will.
This is one of those raging debates right now. Oh, Dan, the interesting thing is that one of the things I like about not being an investor then is I had no money at that time to invest. So, if you have no money, you can lose no money. So, that's a good position to be in sometimes. Well, one of the things is, I think a very common chart people like pulling out, they'll pull out a chart of, say, PE ratios that goes back, to pre-1999, and you'll see that the PE ratio go up, and then post 2000, and then sort of is going up, and it seems like it is hitting the PE ratios of like early 2000s or something like that. Or you could do a graph of the price to sales ratio and probably see something that looks very similar. And I think, what I call it, it's like, that's basically first level thinking, right? That's like, okay, I pulled a couple of data points, got a nice graph, and here's it, and I made my case. And as with statistics, right, statistics can be made to lie by improper usage all the time. So this is, I personally feel that's the case. And the reason behind that would be, if you think about it, and Dan, you just alluded to that, right? There was no revenues. Many companies at that time worked. There was like .com, and there were many.
You can't have an E. There was no E part of the equation. I've talked about this before, but we did a promotion for Ford for the new Focus when we were at Uproar, and we changed our bingo game to Focus. Pretty dumb promotion, frankly. But they paid us $50,000, and it cost us like $80,000 to build it and serve it. So it was all a shell game. And really, and we'll let Simon weigh in here. That's what's different now, right, Simon? Besides, we'll talk technology cost. The revenue picture is very, very different here.
The fundamentals of any company is the exhaust of how the car is being driven, right? Whether we're talking earnings, cash flows, revenues, it's all downstream of the decisions that are being made up front. And the business model in the .coms was advertising, page views, like you just mentioned, Dan, which is great when times are great. But then what happens when that dries up and you have zero revenue all of a sudden? Bad news. And I think that today, when you look at the tech companies that are out there, they kind of all figured out this is not sustainable to just only rely on advertising. We need to have a subscription product to lock in retention rates through our high retention rates with customers. And it's a much more reliable denominator when you're looking at price to sales, price to cash flows, or whatever fundamental you want to look at. And what does Wall Street love? What does institutional money love? It loves predictability. It loves to know you've got 90% plus retention rates and X number of remaining performance obligations already lined up from happy customers. And so in my opinion, is exactly what Anirban just said, which is it is not the same climate for the technology world today that we saw 20 years ago. I don't think it's fair to make those side-by-side comparisons to the .com bubble bust, which was based entirely, or at least primarily, on advertising.
No, it's not. And when you look at, say, some of the highly valued, let's pick Teladoc, a company we were sort of talking about a minute ago. You might argue that post-pandemic, Teladoc's growth is going to slow. It might not earn its valuation for a few years. That could be true with Zoom. That could be true with other things. But they're not going to go to zero. You're not going to see this and when you really looked at some of the most powerful, 90s most popular sites, there simply was no path to profitability. And part of that was due to server costs. The cloud means that if right now, if the 7 Investing website is flooded with 10 million people who want to learn about our new advisor, we already have the software, the things in the cloud to deal with that. And it just happens. As opposed to back in the 90s, I would get beeped, literally beeped on a beeper that our servers were going down and a team of people in a room full of computers would have to deal with it. And it was very, very expensive. That's different now. I worked on a website a while back, a few years ago, where I think it was DJ Khaled or somebody fairly famous, someone like that, tweeted out one of our stories, and like a site that got 100,000 page views a week was getting like 100,000 page views every 5 minutes. And with things like Cloudflare, you have, and the cloud in general, you have the ability to deal with that. But there are other factors at play here too. So I'm going to go back to Anirban. How do cash cheap cash and inflation play a role in this. That's definitely something that, we're seeing tiny little inflation hints, and the market will be down 400 points. How do they play a role here?
Yeah, so I think that's a good point. Like, I mean, basically, you value companies traditionally, right, as the discounted sum of the future cash flows, right? And the discount rate typically is some function of the cost of capital, and sort of some function of the risk-free rate, right? I mean, so, but the important, I think, that at a very high level, right, the risk-free or the Fed rate was what, 6% or something like that around the dot-com crisis. It's like 0 now. So it might go to 1%, maybe. We don't know. Maybe it goes to 2%. It's 2% is not the same thing as 6%. There's a big difference there, right? And currently it's like what, 0.25 or between 0 and 0.25 or whatever it is. Like, basically, I call it 0. The rates are 0. So I mean, money is cheap. There's a funny thing though that can happen with cheap money, right? Cheap money actually, one of the things that Simon talked about is the predictability of software companies. A lot of the tech companies actually do not need capital, right? And I call this capitalism without capital, right? Even if you think about today, that's a fantastic book actually for people to read. If there's a book recommendation today, free on 7 Investing Now, capitalism without capital, it'll change your mind about how you think about companies. Back in the day, Microsoft had to sell CDs with software loaded on it. Today, it just puts it on the web. It doesn't even put it on the web for you to download. It just basically automatically downloads because it's all running on the servers, right? And the servers are infinitely cheaper than probably actually making those CDs and printing those CDs. So that's that. The other thing with cheap capital, there's a funny side to cheap capital, which is cheap capital actually makes it easy for substandard business to survive longer. That is the unfortunate part of cheap capital, right? When many of the great companies, the good companies, do not need cheap capital, but those companies which need cheap capital can actually invest like crazy for future, essentially future growth, because the cost of capital is very low. I think that's the important thing to realize. I think those are the key differences. So in terms of business models and in terms of like just cost of capital, but the inflation that you talked about, right? I personally feel, this is, again, I'm not an economist, but I personally feel like a couple of things. If you think about what software is doing, software is increasing productivity and reducing cost of doing work, right? You don't need an accountant today. You don't need a bookkeeper. Technically, your bookkeeping is actually all done online. You still need an accountant. And if you think about what something like telecom is, actually reducing cost of delivering medicine, right? So cost of getting things is going down. Well, then how does inflation happen? Right, there's only so much jeans you can buy, and so much coffee you can drink, and so much food you can eat. You can't consume more, and you can even consume more, but the cost is not going up because cost of delivering things is actually going down. Couple that with globalization, right? We basically buy things, produce things at the cheapest location, and the location changes, right? If China was cheap, then it goes to China. If China is no longer cheap, it goes to Vietnam, right? So, call it the importation of deflation. This is very hard, I think, to get inflation, right? I mean, the third point would be that you could get some, I guess, wage growth happening if, and that's probably going to happen at the higher end of things, right? If you want to hire more automation engineers, and those are in short supply, then the cost of those people actually go up. But I just think like we're going to have short-term inflation because of all this money that has been printed, and the reopening trade, and people are going to be there is some pent-up demand. But I just think sustained inflation is going to be really, really hard. So I don't know.
It's 2:30 in the morning in Australia. We're going to put that how much coffee you can drink to the test. Simon, did you have a comment before we move on?
I do. By the way, amazing. By the way, Anirban, that it's 3 a.m. and still to have that kind of insight so early is impressive. Just to chime in on what you said about the DCFs, the discounted cash flow analysis, that was kind of always the right answer for what a company's valuation is worth, right? This goes back to Warren Buffett, before that Ben Graham, all of the kind of the teachings of value investors of find out what is the right discount rate, discount back all of the free cash flows, take out your debt that you have on the balance sheet right now. And that's the value for equity holders. That is what your stock is worth. But it's always wrong. The number is always wrong. You can have 40 tabs open and it's never going to be right because all the inputs are so sensitive, right? Tell me what the interest rate is going to be 5 years from now, and I'll tell you it's not going to be right. There's no one that can predict that far into the future. And so I think that the interesting discussion for this today in today's environment, especially for technology companies, as you mentioned, Anirban, that are deflationary by nature, is maybe there's less of an emphasis on the DCFs, or the weighted average cost of capital versus the return on invested capital that we've gotten so used to in institutional investing, and throwing out price targets and, this is what the value per share should, quote unquote, be worth. I think that we're much more right now, a much more interesting perspective is how quickly can this land and expand model in the technology world, as we're going through the digital transformation, catch on. Because if we're subscription based and everyone wants to get as many users as you can possibly pile onto their platform, how quickly can you scale and capture revenue from that? And that's what you've seen with all the tech companies, right? How many people can you get in? How many can you convert to paying subscribers? It's much more interesting, the comparison between the acquisition cost of new paying subscribers to the lifetime value of those subscribers over time. Across the board, any technology company, right? Unless you're building oil rigs out in the middle of the ocean, which have, set cash flows and production volumes and such like that. I mean, in the technology world, we're paying premium valuations as the price to sales continues to climb, because companies are all kind of adopting that land and expand. And so my final thoughts on this is why you see so much volatility in the market, but also why there's really no ceilings. We talked about S-curves earlier. There's no ceilings on big tech companies and how large they can become. You're starting to see Microsoft and IBM trying to go open source, right? GitHub, Red Hat, whatever it might be. You want to get as many users plugged in as possible. There's a reason we're not doing proprietary software anymore. This is a new era of technology, which is kind of exciting for tech investors like we are, for innovation, and for companies that are investing ahead of the curve, because you can really get 10x returns that are not being accounted for in those price targets and a lot of those institutional price models.
So we'd love your questions and comments. Simon, of course, says we can't predict future interest rates. I'm guessing that means you're not talking to my friend Zoltan the Magnificent for our seventh thing. He's one of those guys, lives in the plastic box, gives you your future. I feel he could do it, but I totally respect, as CEO, you're not going to go in that direction. If you're watching this, wherever you're watching this, if you type in questions and comments, we see a ton of welcome to Anirban, and we really appreciate that. We're going to work on pronouncing your name correctly. We've both been doing it wrong for quite a while. We're going to finish up with one last question. We're going to throw it out to our friend in Australia. Do you think people are making a mistake shifting investments into so-called recovery plays?
That's a really good one. So. It depends, right? I mean, I have to give this example of, say, take Booking.com, right? When Booking.com was sold off in March of 2020, yes, probably was sold off for the right reason, because you didn't have good visibility of what's going to happen in the future. But by as soon as you knew the therapeutics were there, you're going to have some sort of treatment, vaccination. That was a play to have at that point, right? At this point, if it is fully valued, well, I mean, then, what's the point of actually going to a fully valued company, right? And again, I'm just using it as an example, not necessarily saying that Booking.com is fully valued. But I think that's what I feel like. A lot of the recovery plays, the economy is going to open up, retail is going to open up, and I'm going to go and, people are going to buy in those beaten down retailers, but the stock price of those companies are no longer beaten down, right? They are really, really expensive. Or you could buy airlines, or oil companies. Like, I mean, are we going to really consume that much more oil, right? That's I feel is the issue. And people, I think volatility, actually, I love volatility because to me, it means a couple of things. The market is sane. It gives me real pleasure to see that volatility, because it tells me the market is sane and is not insane. And the other thing is, gives people who have regular cash flow an opportunity to invest, right? So I mean, you get to buy things on the cheaper when they're cheap. So I think the time to play recovery plays has actually sort of long passed. If you did that 6 months ago, you'd actually be sitting on a handy, the Expedias of the world and Booking.com of the world and all, they were actually on discount. I don't know whether the discount gap has shrunk. With tech, I'd say right now tech has pulled back, as Simon has said, right? They pulled back. Valuations high, they've come back, but their growth runways have not changed. And in many ways, here's the thing, right? If the economy is opening up, if the recovery is going to play out, then digital transformations of companies should actually accelerate, not decelerate, right? So I don't know. Like, I mean, it seems to me that the tech should continue seeing larger and larger share happening and being taken by these companies. So I don't know. I continue to hold a lot of tech stocks. I believe in it for the long term, and volatility to me looks an opportunity to add to companies.
Couple of notes here. Daniel Kern 79. That is a big question. Sam Bailey, if you could write that down. We will answer that on another show. Anirban and I are going to tape a couple of times a week so he doesn't have to appear live at 3 in the morning. He'll be on our team calls. He'll be on when it's special. He'll be a regular presence on 7 Investing Now, but it will likely be in tape segments. One of the cool things we can do here on the platform we use is we can tape things, and that's going to become more evident when we get back to a more normal world and start going to trade shows and can get in front of CEOs and opinion makers and just all sorts of people. I will say on the recovery stocks, the one thing I'm looking for is companies that were good companies before the pandemic, where opportunity opened up because of the pandemic. There's one that I'm right on the cusp about. You mentioned airlines. I would say no to every airline except Southwest. And I would argue that Southwest is incredibly well run. They handled the pandemic really well. They ordered 100 737 MAXs today because they are expanding into more airports. They are taking advantage of the fact that their peers who had lost money repeatedly, Southwest has only lost money 1 year, and that was due to the pandemic. They're able to expand and go into different places. That is going to benefit them. I'm not entirely sure that makes them investable, only because we're definitely going to get that boom of we're open, go visit grandma, go to Disney World, go to Las Vegas. But that might be a 3-month thing. That's not necessarily like one of the things we talk about in retail is people overvalue holiday sales. There was a year, a couple years ago, where JCPenney had a surprisingly good holiday. And you know why it had a surprisingly good holiday? Because stuff sold out other places. And at the end, people are like, oh, crud, I better go to JCPenney. That doesn't change the long-term vector for JCPenney unless you went into the store and went, wow, it's awesome. Now, I would argue with Southwest that if you were flying other airlines, there's a pretty good chance that you're going to get on a Southwest flight, and you might not like the seating policy if you don't understand it, but you're going to love that you could change your ticket without losing money. You're going to love how sort of easy everything is, how nice they are to you, how the built-in television, which is not a physical TV, it's on your device. So many things going for it. I do think that is going to be a factor. We appreciate so many of you tuning in to watch this big announcement. We're going to skip what we're watching today.
Can I chime in with just one more comment?
Absolutely.
I think this is one of my favorite things about the structure of our team. It is kind of all of this is blending together right now, right? Like you mentioned, and I know you have a background in retail, right? The operations of you ran a retail location in the past. And like this is kind of like 101 for retail of like how do you treat your consumers and loyalty and efficiency and all those things. We just mentioned about it in terms of Southwest, but how many other companies would not be called tech companies 10 years ago that suddenly are tech companies today, right? Like Zoom Video Communications. If we use Zoom on a daily basis, Zoom is not a tech company. It has a handful of patents, maybe 5 at tops. The encoding and decoding of the video it's commercially available stuff. It's just got an audience that it's making super happy because it's customer focused. Peloton sells bicycles, the stationary treadmills now too. I mean, this is not a super complex organization, but it's got that user base. It's figuring out the loyalty. It's figuring out the community. I mean, stuff that we called retail a couple of years ago is now a tech company today that's getting the highest valuations in the market. I guess the only point I wanted to kind of chime in with on that is a lot of this is blending together, and it kind of takes a lot of different ways to think about these types of companies we're investing in.
Yeah, and it's one of the reasons I'm most excited Anirban is joining us is because it's all these different perspectives. Like you mentioned, I spent 2 years running a gigantic toy store, and that gives you a lot of perspectives on the holidays. Because what was my goal during the holidays as the general manager? My goal was, one, to make sure we had products to sell. We had to replenish on a daily basis, and finding sales channels to do that was not always easy. You had to plan 6 months ahead. For say, Lego, you had to plan a year ahead and adjust as you went. The other thing I considered really important was when a new face walked into the store, not my loyal customer who shopped there every week or shopped there for every occasion, a new person walked into the store, I had to make a connection with that customer. So if we're looking at Southwest or Royal Caribbean or any of the well-run companies that were recovery plays before the pandemic, what's the experience going to be like when they have that opportunity to capture a customer? So the fact that a Southwest flight attendant is going to be attentive, is going to, take care of your unattended minor or help you deal with whatever problem you have. You're going to, they'll bring back the airline magazine and you could read, they probably won't, but pretending they did, you could read those stories in the front of Southwest Airlines about flight attendants going to incredible lengths to help consumers. That's what businesses are based on. So if I show up at a JCPenney and they do something spectacular, like maybe I go to a Nordstrom and I notice, oh my God, there's a Warby Parker here. I've always wanted to try on 100 glasses, not just the 5 they'd mail me, which would infuriate them because they have to disinfect every one now. But let's pretend I did that. That might be a transformative experience. We're seeing massive shifts and how things operate. I shared with the team today, Nike is pulling out of even more stores to go direct to consumer. You're seeing big shifts, and all of us have touched that from different angles. Not going to belabor this, but it is absolutely exciting as we see how this team is coming together. So let's hit the home stretch here. And what I'd like each of you guys to share is the best investing advice you've ever received. Simon, I'll let you go first on this one.
Yeah, real quick on this one. First boss out of college, I think I spent my 20s in direct sales, so flying around a lot of those airlines we talked about, and shaking hands and racking up frequent flyer miles. But his advice was save relentlessly as quickly as you possibly can. That's tough when you're 23 years old, right? He also said go out and enjoy your 20s. You're never going to get to be 23 again. But what an opportunity to put some money aside, even at a young age, and let it compound for decades. Your future self will thank you for doing that. So start as early as you possibly can.
I'm going to go next, and then I'll let Anirban close it out. So I'm going to say one really important thing. I'm changing from what I put in the document. Live below your means. And I think this is really a tough one because my wife and I have owned something like 13 houses. I think we moved every year for the first 10 years we were married, largely because housing values were going up before we had a kid. That meant you could sell your house, make the money, move to someplace where the schools didn't matter, and still be affordable. When we had a kid, that changed a little bit. I have a 17-year-old son now. But that being said, if you can clearly afford where you live, we always did it. If one of us lost our job, could we still pay our mortgage and still get by? And if we could do that, that gives us a lot of excess cash, and that covers our mistakes. That not only leaves money to invest, but that covers the fact that I maybe bought 2 or 3 more computers than I needed to during the pandemic, or I tend to travel impulsively, and I gamble, usually well, but not always well. So if you live below your means, you have money to save, you have money to invest, you also have money for opportunity. We're seeing during the pandemic, hey, you want to book a 10-day cruise to Alaska for 2023? Well, geez, we really want that booking. So normally it's $6,000. Now it's $1,200. Well, $1,200 is $1 million if you don't have $1,200. But if you do have $1,200, that's an opportunity. We saw at the beginning of the pandemic, people buying up vacation homes because they were sort of at an all-time low in value. That's no longer true. But if you have money, that gives you opportunity. And we're going to see that play out in all sorts of different ways. But to bring us home, we will take it to our newest lead advisor. That is, of course, Anirban.
Thank you. So actually, it's going to be hard to top those two because those two are actually probably foundational and foundational link for investing. So save and spend less, right? Well, I'm going to actually go a different route here, slightly different route, which is not really an investing, but something that I learned from my computer science is a quote from George Box, which is all models are wrong. Only some models are useful. And I find this incredibly useful for investing because, there's a lot of false precision in investing, right? You talk about price targets, Simon talked about, people will give, this is the valuation, I think, of this company today. But that's false precision because you can't know the future, right? And knowing the future is hard. There's so many variables out there. So what you want to do is your model is only good if it actually gives you good insights, right? So you want to focus on understanding the business, and you want to focus on sort of the forest, not the trees, and that really, really helps you if to invest, because then you can take a very holistic approach to investing, and you don't get caught up. Oh, I want to buy this $1 less than the fair value is 55 and it's 54, so I'm not going to buy, and that causes a lot of pain to people. So I try to stay away from all sorts of false positions. Like, I love the company, I think it's good, and it's going to be many times its size today. That's good enough for me, and I'll take the volatility along the way.
Yeah, I don't believe in any hard and fast rules. And what's interesting is that you bring a heavily research intensive approach. I start with, I'll call it almost a touchy-feely approach. Like, a company impacts me, and then I look and see whether it's a good company. And sometimes it is. Sometimes you're like, oh, like Chipotle is an awesome company. Starbucks, great company. Others you might look at it and go like, oh, good product. Maybe not as good a company. And we all do it different ways. But I will say we're all flexible. We've all made multiple purchases recommended by other people on the team. And that might be the number one thing I can say that speaks to us, that we are all professional investors that are buying things that other members of the team have pitched at our team calls. With that being said, we're nearing the end of the show. Sam Bailey, we are heading up to the top rope. It is time to hit our finisher. Which 2021 IPO or planned IPO will be the most valuable in 2031? This was really close between Coinbase and Roblox. I actually think that's probably correct. I don't know which of them it's going to be. I don't think it's going to be Instacart. I think it's going to be very difficult to make money with delivery, and people are going to be a little more upset about the markup. And Robinhood, I'm not going there. Simon Erickson, you are welcome to chime in.
Not Robinhood. I vote not C is the right answer for this one. I would probably go with Coinbase. I just think this is a new field. Cryptocurrencies. We partner with our partner Crypto EQ for a lot of the analysis on that. But just to see them now and the momentum that they have in their IPO, it's not just commissions. They've got a business side of this where they're getting enterprises onto blockchains as well. I think we're at the early innings of this, even at the valuation that we're talking about today. I think there's plenty of room for growth. I vote Coinbase.
And this is a perfect example where being a good business doesn't make you a good investment. I used Instacart 3 times this weekend because I was busy. I was prepping things. I was finishing my all sorts of stuff. So I had food, I had alcohol, I had who knows what delivered via Instacart. But I know I'm paying extra. I know it's stupid because I live less than a mile from all those stores. And I know I'd probably forget something and end up going to the store, which I did. I went to Whole Foods at about 5 o'clock yesterday. So it's a great product. It's not necessarily going to be a high growth investable business. But Anirban, we will give you the final word on this topic as we close out 7 Investing Now.
I'm a big fan actually of crowdsourced opinion here. So I'm not going to actually even digress from what the crowd is saying. If the crowd says Coinbase, then I'm going to stick with Coinbase. Although, Roblox is an interesting choice as well. But yeah, I have actually nothing to add to what has been added already. So I think I'm going to stick with the wisdom of the crowds here.
Simon, before we close out here, not everyone has been watching the whole show. And if you haven't been watching the whole show, what else were you doing? No, just kidding. We understand you have busy lives. We appreciate you subscribing to this show, whether it's watching it at 7investing.com/live screen, downloading it as a podcast from every place podcasts are available, watching it on YouTube, through our Twitter handles, wherever it might be. We very much appreciate that. But Simon, we highlighted the show with introducing our newest lead advisor. Why don't you sort of do that again, just to bring it all home for anyone who tuned in late?
Oh, I'm so excited to do this. I can do this 10 more times because every time I'm still stoked to announce our newest advisor on the team. Anirban Mahanti has just joined the 7 Investing Group as the lead advisor. Follow him at 7A Mahanti. If we can throw that perhaps up on the screen. If not, you see it right there on his title. Oh, there we go. Perfect. Follow him on Twitter. We're going to be sharing a lot of his thoughts, a very technical background that Anirban has from years of running research institutions. Just an incredible investor, also a great personal friend of mine. I couldn't be more excited to welcome him to the 7 Investing team here today.
With that, we're basically at the end of the program. If you'd like to get in touch with us, if you have questions about being a member, your membership, any of the advisors, if you want to suggest a place I should go once the world opens up, you can email us at info@7investing.com. Usually Steve Symington answering those, but he does send them out in our Slack to the entire team. We are now more than ever a 24/7 team because I went to bed at like 10:30 last night, And I got up at like 1 and I looked at my phone and there were like 900 Slack messages because we are now, of course, in an awful lot of time zones. And if you want to interact with us online, we share a lot of polls, we share a lot of thoughts. I try to be silly at least every third or fourth post. You can reach us. We are at 7investing on Twitter. That's a good way to find all our personal handles as well. Of course, we keep things, serious on the @7investing handle. My personal handle might get a little fun and goofy from time to time. We appreciate everyone watching. We were really excited about this. There was not a lot of sleep on the 7investing team this weekend. And oh boy, is there more to come. We absolutely say 7investing.com/subscribe. Join us. Be there before April 1st to see our next set of picks. But for Anirban, for Simon, for Sam Bailey behind the glass, thank you. We will see you Wednesday. No show on Friday. It's Good Friday. Bye.